We've seen lower interest rates help in various ways. Would they help this problem?
Well, this is a supply shock. So monetary policy has a hard time addressing supply shocks. They do a whole lot better when it's a demand shock, when it's a demand inefficiency. The other major challenge, of course, is that it's a virus that could or could not spread quickly. It could change behavior or not. I mean, the reality is that we don't know. Central bankers don't know. That said, what central bankers do know and what they are looking at very carefully is what markets are telling them. And that's a really important piece of data for them. It's early indications that there's something problematic, and certainly something that's worrying market participants. So I think from the Fed's point of view, a rate cut is on the table. It is on the table because financial conditions have deteriorated. If they see credit freezing up, if they see, further sell-off in the market, further increase in volatility, further inversion of the yield curve, and if the bond market starts to really pressure the Fed to move, more likely than not, they will deliver, even if they don't see the hard evidence in the economy.
So, Jim, if the Fed pays attention to the markets, one of the things the market's telling right now is they should cut rates. If you look at the Fed, the markets, they're saying they're expecting maybe 3 rate cuts this year.
That's true. I think what the stock market and the bond market is telling you is that they're afraid that people are not going to want to come out of their homes. They're going to self-quarantine. And if the issue is people self-quarantining, then lower interest rates aren't going to make a difference. If people are afraid of walking on the street and getting sick, no matter how low interest rates are, they're not going to come out. So I think the Fed needs to be very careful to think about exactly what they're solving for and what they think their rate actions are going to do.
What should the Fed be doing even apart from the coronavirus?
Apart from the coronavirus, my own view is that interest rates are too low. As I said before, 10-year notes are a 130 yield. The CPI is 100 basis points higher. In the old days, 20, 30, 40 years ago, people got defined benefit pensions. Today, they've got defined contribution pensions. So they're saving for their retirement. When we used to have 200 basis points of real return, you had the magic of compound interest working for the saver. So they'd have a lot more money when they retired because they were able to earn 200 basis points over the inflation rate for many years. Today, when you can't even earn the inflation rate, that means savers have to save dollar for their retirement. And what that means is that instead of retiring at 63, 65, 67, they're going to have to wait to 75 or 80 in order to retire. And that is going to be quite a shock to a lot of younger workers.
And yet, Michelle, if anything, I think what we've seen is savings rates go up. Actually, as the rates have come down, people save more and more and more. There was a time we were worried about capital formation and not having enough savings as a country to invest. Now it looks like there's plenty of money to invest. It's not clear we have enough things to invest in.
Yeah, I mean, part of the reason you can make the argument that the savings rate has gone up is that you need to just put more dollars away in order to get the same return because, to Jim's point, interest rates are so low. But yeah, I think that, certainly you've seen distortions in the economy and markets as a result of central bank policy. Some of those distortions are intentional, right? The way that monetary policy works when you're so close to zero lower bound and you've expanded your balance sheet so much is by forcing investors into other asset classes to take on risk. And in theory, that creates wealth, and then that bleeds more, into the broader economy. But that also means that it could change behavior in a way that maybe is damaging and maybe does have these consequences down the line that we just don't know about right now.
I think also what the Fed has done, as well as the European Central Bank and the Japanese Central Bank, they've created a short squeeze in term securities. They've bought, 10, 12, or $14 trillion of term securities that the market otherwise would have bought. They're still out of the market, so the market needed those securities, can't get them, and so they're reaching for other things. And so the reason those term rates are so low is because the Fed and the other central banks have absolutely engineered that.
So, Michelle, put over the top of that something Jim actually talked about, which is an aging population.
Yeah.
Not just in the United States, but globally. So you have more and more people going into retirement who are going to need those savings.
Yeah.
And so there's more and more demand for long-term sort of fixed income.
Yeah, that's absolutely right. I mean, the demographics are not favorable. They're not favorable for that reason. They're not favorable either in terms of, the ability to have expansions, right? Just in terms of potential growth. With an aging population, you tend to have lower labor force participation rate. But probably what you'll end up seeing is people will be working longer, as you suggested. They won't have the luxury of retiring as quickly because you don't necessarily have that savings buffer that you've had in prior years because interest rates are so low. So there are a lot of consequences of the central bank experiment, certainly, and those consequences will be felt for years. But the reality is that when we face such a big crisis, when we face the great financial recession, there were little choices out there. I think it's less about what was done at the time, and it's more about how that normalization didn't quite work out.
Yeah, exactly. I'm not sure this is saying we shouldn't have done what we did in 2008, 2009, and the central bank shouldn't. At the same time, I wonder, as somebody who runs a business, how does this affect your business? I mean, when I was at capital cities and at Disney, we would think about the cost of capital as we made decisions, and the cost of capital was fairly substantial. You had to get to a hurdle rate to get there. Has that really almost gone away for you now in terms of cost of capital because it's so inexpensive?
Well, cost of capital is dramatically lower. That's for sure. But the other problem is rates have been so low for so long that for many companies, they've already accelerated their capital spending. And in classical economics, low interest rates should lead to increased capital spending. But not if everybody has built what they need to build. And what seems to me to be the case is that businesses are pretty comfortable with the capital stock that they have. And so I don't know how stimulative a decline in interest rates will be from here.
I think one of the things that really worries me is what's the next step for central banks, right? So you have a lot of central banks that are low on ammunition. The Fed actually looks like they have a whole lot more ammunition. The ECB certainly does, and the Bank of Japan does, and the Fed's ammunition is still very limited, right? So I think that's also one of the concerns, that if you never really truly normalize your policy when you're in the recovery, when the next recession hits, what are your tools?
That's right. They've got to raise interest rates so they can lower them.
And that's a really uncomfortable place to be. And I think for central bankers right now, we're in they're facing this big risk factor.
That's right.